The risk of bank defaults spreads across Europe. In the dimly lit office of Man Group in London, Jonathan Golan, a seasoned portfolio manager, leaned forward, his expression grave as he contemplated the unfolding financial landscape. "There are parts of the market," he murmured, his voice tinged with concern, "that in our opinion are in deep trouble." The recent tumultuous nosedive of New York Community Bancorp's stocks since the beginning of the month served as a stark reminder of the jittery nerves lurking within the markets, particularly concerning potential defaults in commercial real estate loans in the U.S. And this unease wasn't confined to the American shores alone. This week witnessed a ripple effect of nervousness even in the bonds of the German Pfandbriefbank. The stock of New York Community Bancorp has plummeted by 70% within a week due to concerns over its exposure to commercial real estate loans in the U.S. The bank is now looking to sell off assets and is in talks to offload mortgage risks and sell loan portfolios. It recently reported an unexpected loss and announced a dividend cut. The newly appointed CEO aims to raise new capital and reduce the bank's exposure to commercial real estate. Moody's Investors Service downgraded the bank's credit rating to junk status, citing complex financial risks and governance challenges. The nervousness gripping the banking sector won't be contained within the borders of the U.S., Jonathan continued, his gaze focused. The peril of defaults could very well extend its reach into Europe. Bloomberg, the financial oracle, echoed his sentiments, articulating the investors' apprehension about U.S. commercial real estate, which had already cast its shadow over global markets. The plummeting stocks of New York Community Bancorp, German Pfandbriefbank, and Japanese Aozora Bank were stark indicators of the growing anxiety, leaving traders on edge, speculating about the next domino to fall. In Germany and Scandinavia, we see commercial real estate as a percentage of tangible equity ranging from 400, 500, 600 to 700%, Jonathan explained in an interview, his tone laced with a sense of urgency. If each of these banks were to take a write-down of 15 cents for every dollar lent to commercial real estate, a scenario I consider not as a worst case, but rather a wholly plausible one. These banks would not only lose their investment-grade status, but also face insolvency. Signs of contagion were already manifesting. Bonds of German banks specializing in real estate took a nosedive this week following Morgan Stanley analysts' recommendation to their clients to offload senior bonds of the Pfandbriefbank. The German institution, in response, issued a statement on Wednesday, citing increased provisions due to the persistent weakness in the real estate markets. While Bloomberg Intelligence suggested that U.S. commercial real estate loans, constituting 1% or less of assets, posed no significant threat. As Jonathan wrapped up his assessment, a sense of unease lingered, hinting at the potential consequences for the banking system. The looming threat of defaults, if left unaddressed, could trigger a chain reaction of insolvencies, eroding investor confidence and destabilizing the economy. With global interconnectedness amplifying the risks, regulators face a daunting task in containing the fallout and bolstering resilience. Vigilance and proactive measures are crucial to navigate these uncertain waters and safeguard the stability of the banking sector. Thanks for watching. Hit the subscribe button to be informed for this story to unfold.